Guys, today I have the pleasure to meet my friend Richard Wilson from Family Office Club and other corporations. So welcome aboard, Richard. So please introduce yourself and tell me a little bit more about what you're doing.
Yeah, sure. Appreciate you having me here, CJ. My name is Richard Wilson. I started our investor club called Family Office Club in 2007. Since then, our 20-person team has hosted a little bit under 300 events over those 17 years. We have 14.4 million members in our social media groups, which gets us a lot of deal flow and interest in our live events. And we're currently doing 16 in-person events per year. Couple cool things that we're doing is, we're interviewing 100 billionaires for billionaires.com. And, long term, we're trying to build the #1 most valuable investor club out there, which has in-person events, not just digital, since that's important for building relationships.
Yeah, I assist a few of your conference, and it's major. I like it.
Awesome.
It's really I like the thing that it's you share your knowledge, and everyone on the stage, even like last week with Daniel Puder, awesome guy. It's really awesome, and congratulations for that.
Yeah, thank you. Yeah, we try to make it dynamic and interesting. I mean, after doing almost 300 of these, I don't want to get bored at my own event. So if it feels the same every time, I get bored. If there's a professor showing graphics of gold and macroeconomic trends for 45 minutes, kill me now. So I try to make it very fast paced. Everyone's talking just for 15, 20 minutes. And like last week, we had a UFC undefeated fighter who owns 11 private schools and scaling. Stage in Beverly Hills. It's raised $7 billion for their deals. We have family offices speak. We had a centimillionaire who had a 9-figure exit, and I want to interview those people. So it's exciting for me to be at my own event, and that's kind of the litmus test for, we're basically a bunch of founders and wealth creators like yourself, right? So if you bore people, they're not going to come back.
Cool. So today we're going to talk a little bit about asset allocation, but let me share my screen here and we'll talk about that a little bit. So this is the slide from Tiger 21 for the asset allocation of their member. But do you agree with that, or what do you think about that slide?
Right. I like it because the allocation is going to be custom to who somebody is, or at least it should be, right? I would not follow something like this and say, this is what we need to do, like robotically, obviously, right? So lots of families worth under 50 or 70 million really value income. But a lot of families that are worth 70 or 100 million or a couple hundred million, even a 2% income drip off an investment might be enough to meet their spending needs as a family. So income might be lower on the priority list. If you love where the public markets are at and think they're massively undervalued, which apparently, with the recent tech drawdown, not everyone thought that, then you might put more into. If you think equity is overpriced, you might put a little bit less. And families have an intuitive sense of just how much they trust certain areas at different times in the market. So they're not trying to time the market like intraday or intra-month. But in general, they have a pretty good gut feel as a founder and wealth creator when the market's gone down 90% and Marriott is on sale massively along with every other big blue chip brand, people overallocate to that niche. So the other thing I want to comment real quick on here is that many times allocating to direct investments in real estate and private equity takes time to build trust, conduct due diligence. So you might have an ideal allocation, and over time, you sometimes might get a little bit over allocated to one area and correct that over time, or you're under allocated, so you just haven't met the right self-storage group or the right medical practice group that you really would love to invest in. So those are just some of the, feedback I would have on it.
Okay. So, and what about real estate? I know you talk a lot about the real estate at the last meeting. So, is that okay to allocate like about 25% of in real estate, or?
It's particular to like what industry the family made their money in. If somebody made their money in real estate, then some of my clients who made their money in the space have 70, 80, 90% of their net worth.
Okay.
But typically, those who did not make their money in real estate, in my experience, most often, if they're worth tens of millions of dollars, have somewhere between, I'd say 25% on the low end. I'd say on average, it's typically 30, 35%. Okay. for real estate allocations, and they're usually choosing 2 to 5 states that they like more than other states. They're choosing 5 to 10 brain trusts, like 5 to 10 different real estate managers,
Okay.
and saying, we like these food groups. So like we like mobile home parks, multifamily and storage. We like these 5 states or 2 states. And we like these investment managers. So they're getting more involved typically than they do in their equity portfolio, where they're just saying like, hey, I like Tesla and Costco and diversify me otherwise, or whatever, you know?
That's cool. That's
Yeah.
cool. And you were talking also last week about the like the three main asset allocation for ultra network individuals and family office. Can you tell me more a little bit about?
Sure, sure. Yeah, let me draw just like a real quick diagram that's probably not going to look too pretty, but at least I'll add a little visual. So
That's
what we
okay.
find is that clients have 3 main buckets that they invest their capital into. Let's say that the founder is up here. They're typically putting money into wealth management, which is mass diversification, mostly just playing defense,
Okay.
sometimes producing some income. Then very conservative cash flowing real estate, maybe some conservative private equity as well there, but really conservative cash flowing assets, not super high leverage. But here you're more than tracking inflation, producing income, typically hard assets, different brain trusts, different states and food groups. And then the third area is playing offense. And that's usually focusing on 1 or 2 niche areas, usually where you created your wealth or where you see the creation of wealth in the future. And this is where you're playing offense as a family.
Okay.
And so the reason we bring this up is that I don't see too many people being the champion for the private investors out there. Because if you think about it, the people selling real estate and private equity investments, they want you to put your money with them. And the people selling wealth management, they tell you they're independent and they're fee only, but they also only make a fee if you put all your money on their platform typically.
Yeah.
So who's out there telling founders that like, hey, you can be diversified, highly diversified here, be diversified in real estate, hard assets, cash flow in here, but also play a strong offense here and use strategies like acquiring choke point assets, you know, figuring out a niche you really want to dominate, figuring out the sandbox you want to be focused on, and connecting with peers and capital and talent and distribution to really dominate a niche there. And founders are really under-advised here and really under-advised here, and sometimes need to upgrade who they work with there. And so that's kind of like what our investor club does, is really trying to work with sharing those best practices. And everyone in our group is really trying to scale their balance sheet most effectively, and usually using this type of thinking in terms of where they're allocating to most often.
That's good. And what kind of offense niche that you see quite often those days?
Yeah, many times we have people who are a little bit burnt out on the industry. Maybe they made their money in auto dealerships, they never want to step foot on one again, or their back is tired from being a dentist. They built and sold their 3 medical practices, et cetera. So we encourage people to, even if you're going to focus on a new area, be really niche focused on something that you think has inevitable future demand, you're passionate about, but you have some real strength yourself, distribution access, relationship access, expertise in the family. So it could be that you don't want to practice dentistry anymore, but you've spent 20,000 hours of your life being a dentist or a doctor or running an auto, dealership. Well, then you can invest in other auto dealerships and help them get to a sale. You can invest in somebody else's dental practice and be a board member because you have done what they want to do in the future and you've been down that path. So you're not just bringing a checkbook, you're bringing your capital too. And one thing we really try to enforce is like, you need to get deals first exclusively and at a better valuation than other people. And how do you do that? By adding massively more strategic value than somebody else. And that's how you get deals first exclusively and at a better valuation.
I like that. I really like that. But the thing, like you said, there's always, look, I know private banker, I know wealth manager and everything. They
Right.
always preach for their church. But
Yeah.
I really like the fact that you at the family office, you share knowledge and by educate your investor, by educate your people, it's at the end of the day, I think it's always a better outcome on all that because it's people like to have like it's true you're gonna share for your church, but at the end of the day, it's better to have good knowledge and to educate those professional, those healthcare provider or office family. look, I really appreciate what you're doing. And do you have an idea? Like I had another guy later on today talking about life insurance, like infinite banking.
Right.
What's your thought about that subject?
We do have clients that use it. I think that after digging deep into it on hours of Zoom calls myself, the major downside I came up with, it may not be major for some people at all, but just the downside, if there is one that I've seen, is collateral that may need to be posted up front or collateral that may need to be increased in the future based on movements in the public markets. So when you get your policy or the terms around the collateral that may need to be posted, it's important not to gloss that over and to dig deep on exactly the details of the collateral needed and how that could expand or change to help close a gap of collateral requirements. That would be the thing I would zero in on. And we work with lots of people who are CPAs or attorneys or wealth advisors, and we know some really great ones in all those categories. But one thing that investors have to be careful on is that most people who educate you are trying to sell you that thing they're educating you. And it's the best way to sell is to educate first, right?
Exactly.
And so,
Yeah.
if you ask someone what size yet, usually the person teaching you is trying to sell you the biggest insurance policy possible, right? And same with wealth management, et cetera. So it's just something to always keep in mind as a founder, to make sure you're listening to your gut and intuition on navigating the jungle in the way that's got you to where you are, and come up with a plan that allows you to diversify the brain trust and the people who you're trusting with your capital in a way that feels right to you as an entrepreneur. And you're not just like handing it all over to a third party and crossing your fingers that they're going to do great for you,
Yeah. And lastly, let's say that I'm a young surgeon. I'm just graduated. What do you suggest? Like, I don't know nothing about a good portfolio, how to allocate. What's the best place for me to have those information and the mindset behind what's the approach that I could have to better serve me as a new surgeon?
Yeah. So I have 3 different answers to that. One would be, I'm on a mission to read all 240 books written by billionaires. I've read about 95 of them now. I've got my top 20 list of books that are the best out of those 95 so far. So if anyone wants those, just shoot me a quick email at richard@investorclub.com. That's one answer. One is, we're about to release our 1,000th video on our YouTube channel.
Okay.
Family Office Club is our YouTube channel. So we have 1,000 videos on there. And one of the areas in our YouTube channel is our playlist. And on our playlist, there are 14 videos that are more valuable than the other 1,000. And it's called the How to Start a Family Office mini-series. And it's 14 videos. You can watch it at 1.5x. Each video is 4 to 7 minutes long. And it's like you sat down for an hour and a half coffee with me, and all I did was ramble about the most valuable things possible I could share with you as an investor. That's what that mini series is. So I'd love for you to watch that. We get the most positive feedback from what we share there. And then the third answer is that for surgeons, doctors, dentists, family offices, investors who are not syndicating or raising capital in any way, our events don't cost anything. And you can come to an event that we host. We host 16 events a year, and some of them have 120 speakers on stage over 3 days. So there's no way to leave and not connect with interesting peers. After hearing 120 people on stage, at least 20 of them are going to really connect with who you are and teach you something that's really powerful. And you just leave with a better view of the forest and feel more informed and more confident about your plans.
Yeah, I like that. I like that. So, Richard, always a pleasure. Each time I meet you, I learn something, and I really appreciate that you took time today to share with us. So, thank
Sure.
you, thank you.
Yeah, anytime. Happy to do so. Anytime you need something, let me know. And if anyone has any questions or needs help with anything, our investor club is at familyoffices.com, or you can register as an investor at investorclub.com. And my phone number and email is on those websites. So happy to have people reach out, and we'll happy to keep in touch with you too.